Today we're going to break down the differences between a HELOC and a HELOAN. When should you use one over the other? What are the risks, the strategies, and how do the wealthy use these tools differently than the average consumer? We're going to run through these two different loan products that you may or may not have heard of before. A lot of people get them mixed up, but not you, because you clicked on this video, which means you're doing the work to invest in yourself and your family's future. I'm Peter, this is Jason, and we're the Clear Close, the mortgage experts that get you clear to close on your next mortgage. But before we get to the content, please consider subscribing to the channel, liking this video, and leaving a comment. Anything you do to engage with this content helps the algorithm know that you like this kind of stuff, and it's going to push more information, not just from us, but from other creators to you. These actions cost you nothing, and it supports this channel a ton. So thank you so much, and back to the content. All right, Jason, let's start with the basics. What is a HELOC and what is a HELOAN? Can we define these two similar terms for our people?
Yeah, so basically, a simple way to think of a HELON is it's kind of like your first mortgage because it's going to have a fixed payment and rate over a set period of time. And just like a first mortgage, once you start making those payments, that's it. You're just making the repayment on that debt over a 15 or 30-year time frame, which most of these HELONs are at. To step back a little bit, a HELON, if you want to look at it, it's a home equity loan. So it's a type of cash out refinance without doing a full cash out refinance. So you're not redoing your first mortgage. A lot of us right now, I'm assuming, have some amazing mortgages from back in like 2020, 2021 through the pandemic. And a lot of people, even from like 2016, 2017, that period, you're just like seeing incredibly low rates, which feel like a generation ago. Well, technically it's almost we're halfway there. So it's you want to preserve what's good if you can. With the HELON, for example, it's a fixed rate second mortgage with a payment that's predictable over that period of time. You won't be able to redraw or reuse your equity unless you get a new HELON or you do a complete cash out refinance to replace it. A HELOC on the other end is like a HELON. It is a home equity loan, but it's got a feature on there called a line of credit. So you'll be able to access the equity through a period, could be anywhere between 2, 3, 5, or 10 years, depending on the loan program and the lender. And it gives you access to draw on that line of credit over that period of time.
Awesome. So seems like the HELOAN versus a HELOC. HELOAN means home equity loan, and a HELOC is a home equity line of credit. The product-wise or conceptually, they're kind of the same. You put your house up as collateral, and you borrow money from a lender. These days, most people don't do it from a bank like a B of A or Chase because the customer service isn't that great. The products aren't that great. There's tons of lenders that brokers like you work with, like hundreds of them, right? That give you better service, better options, better mechanics.
It's like every different flavor under the sun. Like, and it can be 10 of these things or 50 of these things, right? It's like it's those like mystery jelly beans, right? You just don't know what you're gonna get.
The Harry Potter jelly beans, yeah.
Yeah, it's crazy. You're gonna get something that tastes like dirt, you know? And and what I mean by that is like the old school bank ways. Because again, a lot of people think HELOC, it's a line of credit. Most people think it's a variable rate, right? But it's not. Like, we have options where it's a fully amortizing fixed rate line of credit. So you know every payment that you make, that you use, that you're on what you're using in the line of credit, it's going to pay itself down to zero. You're not going to have that payment shock. You're not going to have unknown payments month over month. If you're using 20 grand of that HELOC, that payment that you see monthly is the minimum payment. It'll pay itself off to zero. And again, HELON, similar way. So it's like our newer products like HELOCs that have fixed rate, fully amortizing. It's basically an upgraded HELON. So you get all the peace of mind features that you had with the HELON now with the HELOC. And that's what's the major game changer in the last couple of years. It's when
Yeah.
people realize how powerful that tool is with our HELOC now versus the big box banks out there, like that are offering promotional, like you can have a fixed rate for 6 months, 12 months. And then it's variable after that, or you have the ability to get this for free today. But not, in our business and finance, nothing's free. You're paying for it. You're either paying for it with a higher
Oh
interest
yeah.
rate, or when you pay off that HELOC or HELOan, or you don't use it the way the bank wants you to use it and get their permission to use it the way they want it, then you end up paying fees when you pay close out the loan. So it's like, it's so many different ways they structure it. I hate it.
I remember complaining to when I was, my previous position, complaining to the bank like, "Hey man, why is your origination fee so high?" And then they were like, "Hey Peter, it takes money to make money." And I was like, "All right, I'll sign the paper." Shout out to Jay if
You
you're
had no
listening to
choice,
this.
right? It's like and then they know it too. So it's like the banks don't really want to give you HELOCs, is how I see it. Like it's not that's not their like main priority. It's to upsell you on everything else they have: auto loans, personal loans, credit cards, checking, saving account, investment accounts. They want you to do everything with them. So it's like the mortgage side, the HELOC, they don't need it. They don't try to hit it perfectly because they don't need to.
Right, right.
Because they're going to
They don't
sell
need
you
to.
10 different things every time you walk into the branch.
Yeah, it's a difference between going to a specialist versus like a generalist.
Exactly. Exactly.
Okay, so let's talk about structure. Let's get a little bit deeper into these products here. So interest rates versus risk. You touched on it a little bit. Uh, the advertisements that I see for HELONs is like, don't get a HELOC because they have variable interest rates, but we've already debunked that. Um,
Hmm.
there are products out there, HELOC products that have fixed rate interest. So I mean, the products become more comparable. It's just a matter of what structure benefits your financial plan more, right?
But yeah, I mean, it's the usefulness really just comes down to what your financial goals are. Because if you're debt consolidating, a HELOan might be better because it's going to give you a fixed payment over a set period of time, and you're going to hold yourself accountable to it and make those payments, right? And get debt free.
Mm-hmm.
Or a line of credit can still be used in a similar manner, but say you're not trying to consolidate 100 grand in debt, you only need to use maybe 10,000 for that. But then you're an active real estate investor or a business owner, or you want to start a business. You can't get money cheaper than through a home equity line of credit. Like if you've done business financing before, Peter, for your corporations, for your
Yeah.
corporate job, those are not cheap. They're like anywhere between 12 to 20% interest,
Yeah.
whereas you can get business financing for yourself and you be the bank to yourself with a line of credit on your home, and they can be as low as 6.8% on a line of credit. So that's the beauty of those programs. And I see a lot of my like seasoned real estate investors right now over the last couple of years, they've been building up access to equity and capital through these types of programs because they've seen these business cycles multiple times through. So if there's an opportunity, you want to be prepared, and you definitely want to see which one would be better fit for your needs today and tomorrow.
Correct me if I'm wrong. The key difference between the general differences between a HELOC and a HELON is that one is a loan, you just get a lump sum cash payout versus a line of credit, which you have some flexibility. You still have to pay them back at the end because they're both
They're
you're
both
still borrowing
loans,
money, but
yeah,
yeah, they're both loans.
and your house is
But
collateral.
the
So
right, but the amount that you receive when you receive it, that is kind of the difference.
Mhm, exactly, because like a lot of these HELOCs too that people aren't aware, like banks. I keep talking about the banks. Like if you pay them back too quickly on the HELOCs, sorry, not HELOan. If you pay the banks back too quickly on the HELOCs within a set period of time, right? You're gonna owe loan fees.
Yeah, they don't
I've
like
seen
that.
we don't have that because our products, we avoid getting our customers into those types of programs. That's the beauty of working with a broker. We can shop and get to learn every product under the sun and find which ones work, right? And makes the most sense and which lenders to avoid. There's so many lenders we cut off every month that we don't do business with anymore. But that's a different story. As far as the HELOCs, like I was saying, like with banks, I've seen some banks have like you pay back more than 10% of the loan in 36 months or the line of credit that you drew on. Then they're going to tack on loan fees at the end because you paid it back too soon and they didn't make enough money on interest. Or like if you open the HELOC, you have to keep the full line amount open for 180 days. So if you want a $250,000 HELOC, you're paying interest on $250,000 worth of the loan for 6 months minimum. That's how
It's
they're
less flexible.
guaranteeing.
Yeah, they take away
It's
the
like they're guaranteeing
flexibility.
themselves, I'm getting paid for lending you money. I gave it to you for free, quote unquote, but you have to make a monthly payment for 6 months. So it's technically not free, right? You're
Yeah, it's
obligated to keep that
basically
open.
like yeah, it's basically like early prepayment penalties, right?
Kind of, but it's like they structured or word it differently. Like, oh yeah, we'll give you the loan for free. There's no cost to you, but you got to keep that
Hmm.
$250,000
Yeah,
for
they
six
tie you
months. So I'm
into
like,
it.
geez, that's not free. That's like 10, 12, 15 grand in interest. You know, it's
Yeah,
like there's your loan fees right there. It's just like, how's that legal? How can you word it like that? But these attorneys,
yeah.
man,
Well, that's the importance of shopping around, and going to a broker it gives you the flexibility and the ability to shop around for different products, right? I think the misconception is that when they click on that link and then they don't get approved for that initial product, they just give up. But if they just push a little harder, maybe there could be other options. For example, if they disqualify on a HELOC, maybe they can qualify on a HELOAN somewhere else.
exactly. So that's the beauty, Peter. Like when you work with a broker like us, because we're not limited to just the one bucket of programs that are out there at Bank A, right? The biggest bank in the country or the world, right? Starts with the letter C. Um, so they have a specific set of programs. But just because it doesn't work there doesn't mean it doesn't work somewhere else, especially with like these HELOCs and HELONs, because we're not, these are up to the investors and other institutions and hedge funds and banks that buy all this stuff or insurance companies. So there's going to be different programs and features. So if you don't qualify at a bank, banks are the hardest places to qualify for mortgages or any type of home loan. They don't want to lend that money out. So when you see that, it's like you have opportunities out there. You just got to dig a little deeper and find a good broker to work with on it, or B, do a lot of digging around trying to figure out for yourself which options could possibly work, because there's a lot of different programs out there where it's becomes very streamlined. Like our HELOC, for example, the 5-day program, we have the option to verify income electronically, so there's no pay stubs involved or anything like that. You can just use Google Plaid. We use Google Plaid, and we're able to verify through electronic deposits your income. And then if you're in a community property state like California, you can look at your household income with a single applicant, and it just makes it so much smoother, so much faster, and you get day one certainty. Like if we can verify your income today after we generate your HELOC offer, you could be signing tomorrow on your HELOC. So it's like I have people fund of signing in 5 days or less, funding in 7. Like there's no other program out there. No bank can do that.
Now, let's move on to use cases. So, what makes sense for a consumer to use that money on or use that money towards? The temptation when someone comes into a lot of money rapidly is to spend it on consumer goods, maybe on a vacation, something fun, right? Like, hey, we just got $30,000, $40,000. Let's go buy a car. You know?
Isn't that what people already do anyway, though, Peter? I mean, that's why people are asking me for HELOCs, right? Or that's why they're asking us for HELONs and HELOCs, because they've already spent all that money and now they're trying to dig themselves out of a hole. So
Okay,
you
so
got to do
debt
it a smart
consolidation
way.
is one way to utilize your HELOC or HELOAN, which is a good way to use it, definitely. If you have high interest rates of like 25 to
It's not even
35%,
just the high
you know.
interest rates. Like some of these people have they have decent interest rates. There's like 12%
Mhm.
personal loans, right? I mean, I think personal loans are anywhere between like 10 to 15%,
It
but
can go
their
higher.
repayment period is like 24, like 48 months. So like you got a
Wow.
$30,000 personal loan at 12%. It's probably like $1,000 a month.
Well, let's talk about the other side of it. So there's like credit card consolidation or high interest credit consolidation. And then there's the other side where like you can grow your equity. So whenever you get a large sum of money coming in, what do you do with it? If you are in a good position with your credit, if you're in a good position with your finances, and you want to grow, you're in growth mode. Yeah, definitely you can use it to renovate your home. You can use it for to finance a different investment, maybe a second home.
A lot of my clients right now have always been real estate investors. So the really savvy ones that have actually done fix and flip loans or bridge loans or construction draws, ground up construction loans. It's just like, you just know it's such a pain in the butt trying to get draws approved unless you got your whole construction budget up front, which most investors don't do right now. So like those guys, like when I see that, like I see the emails too when you see the draw requests and stuff like that. It's like whoever that approves the draw at the hedge fund, just they're like hawks. They're like, no, I don't see this part of the roof done. You need to retake a photo of that, and then but for now, I'll give you half of what you're approved for. And then it's just like it slows down the construction process. It costs more money. It's like you already put in like 80 grand worth of stuff that you've needed to pay out your subs to build it out, and you're hung up, and now your project takes on another week or two, and that just, you do that several times on the draws, and then it's like
Yeah.
your turn could have been like 45 days turns into 100 days, right? And now you have 4 months of extra interest payments, headache, stress, cash flow. This is where the HELOC really makes a big difference. Imagine every construction loan you've done. That means you've paid origination fees over and over and over again for every single project. But if you have my HELOC and you have 5 years of drawdowns available, that means you're only paying that loan once. And then you're
Origination fee once.
re-accessing
Yeah.
that capital. It doesn't cost you the same $10,000 every time to re-access it, if that makes sense.
Mm-hmm.
So
Mm-hmm.
it's a huge tool for like investors, right? Even for
Yeah.
business owners, like I have other clients that take this funding as business use for their restaurant or tanning salon, whatever business that they have, right? Car wash. And they use that for payroll or whatever, property enhancement, capital expenditures, in business improvements. And again, repay it and reuse it. Because if you try to get like an SBA loan, it's like 13%, right? This could be 7, 8%. It's way cheaper.
Yeah, just to recap, I mean, because the episode is actually about HELONs versus HELOCs, if you were in a situation like this builder and you had to draw like 200K out of your house and he took out a HELON, he would just get that 200K upfront and then
Most likely he would just pay only the minimum monthly payment, but it's just like you're paying so much
on the
interest
repayment
on
side,
that full 200K
yeah, and he
because,
doesn't get to churn it, right?
I mean, he technically does if he sells whatever he put it into, and then he'll recapture his capital. But you're stuck making that 20, 30-year mortgage payment on the 200 grand.
Mm-hmm. Right.
Whereas a HELOC with a draw period, if you know you're only going to use that money for 3 months, you're only paying interest on 3 months worth of it. And
Mm-hmm.
then when you use it again 6 months later, that's when you pay interest again. So it's, again, how you're using it and how what you need it for. Because your project may only require 100 grand, but if you have a line of credit for $500,000, you have $400,000 extra at your disposal when you need it, and you're only paying interest on the 100 grand, not $500,000.
Okay. Well, um, let's bring it home for the audience here. HELOC versus HELON. They both are great products. Depends on your situation, depends on how much flexibility you want with your money, how much access you want with it. If you need help for your specific situation, determining what you need, whether it's a HELOC or a HELON, once again, we have that link in our description. Go ahead and click it, schedule a consultation, and figure out the best way forward for you.
If you need flexibility, go with the HELOC. If you need predictable long-term payments, go with the HELON. But again, as Peter was mentioning, it's very important that you speak with Nikki, myself, or one of our team members on what's available and tailored to your exact needs.
All right. If you've gotten this far into the video, thank you so much for rocking with the Clear Close. We're working hard to bring you unique insights and perspectives in the real estate and mortgage space. And remember, the Clear Close is here to get you clear to close on your next mortgage. Thanks for watching, and we'll see you guys on the next one.